Welcome everyone. My name is Jonathan Shirley. So we're here at the Lead Center, part of UL's College of Business, and an EDA University Center, grant-funded center. So we're trying something new and going to live stream our conversations with an entrepreneur. For those people who are fortunate enough to be here, they will all get extra prizes that none of you get to know about. So maybe next time you can show up and be a part of all of this as well. But we're fortunate enough to do these every Tuesday, and today we're going to, at first I thought we were going to be taking a break from the entrepreneurial side and talking about the investing side, and then we realized that all this is still an entrepreneurship journey anyway. So we're fortunate enough to have Skip Boudreaux here from Acadian Research, Capital, Funding, Money. Skip, thank you for being here.
Yep.
And let's get started. So we start everything with what's the problem? Because everything has to exist to solve a problem. So your company, your groups, what's the problem that they're trying to solve?
Years ago, it's gotten better, but the problem was there just wasn't a lot of accessible capital in Acadian, in this area, right? So if you want to start a business or get funding, like you go find, well, you either bootstrap it, which is very difficult, but sometimes you do need capital, or you find a rich uncle. If you're not lucky enough to have a rich uncle, there's no one in the street with their hand out saying like, hey, we'll take a look at you. You know, not, hey, we'll fund you, but at least, hey, we'll look at you. And so whenever we came along, Acadian Angels came along, that was kind of the purpose, right? So like, you may not get funding, but at least you get a fair shake.
Yeah.
And in the past, that wasn't there.
Gotcha.
That was the main problem we set out to solve.
Now, from an entrepreneurship journey standpoint, like, how did you find yourself in this space? Like, to decide that, I'll try to answer that question. So like, what's your journey to get here?
Would we want to do the 3 5-minute version?
Yeah, like the 3 5-minute version, because we all have meetings.
Let's see. Okay, so I'll start. I was here at UL, engineering, electrical, computer engineering. Realized I didn't want to be an engineer, but it was like, I don't know, 3.5 years into a 4-year degree, and you don't just throw that away. So we kind of finished our line following robot, and then I left and I went straight to the MBA school here, Moody School of Business. Started getting my MBA. At the same time, I was working with a local firm that writes software for chiropractics. EasyBiz, they're still here. So while I'm doing that software, my family's neighbor was a lady named Terracin Dupuy who was running a company called Fuzzy Buns.
Okay.
It was reusable, washable cloth diapers. Some things happened with her software developer, web database developer. He got fired. She came over and my parents' neighbor, and just say like, hey, my developer's going. He thinks Skip can do this, or like, is there anyone could help? And so I looked at it and I was like, oh, why don't you just give me all the passwords and stuff, and I'll let you know. So that was like a Friday. That weekend I taught myself like PHP and SQL, and then Monday I called her back. I was like, yeah, absolutely, I can do this. It was good pay at the time. And so then I started working for her kind of like 2 days a week, and then eventually full time. And then while I'm getting my MBA, I'm starting to get more involved in her, the forecasting and the business side of it, and the ordering and the quality control and all that. She ends up going on Shark Tank in like season 3, like early Shark Tank, before like it was like big and hip. They beat her up pretty bad. What you don't see is it's like an hour and change of dialogue, and they only show you the 10 minutes. It's best for TV. And they'll, as I was telling you the other day, it's like they'll do things. They'll be like, look, if they start to cry, let them, and like, oh, and ask them about their relationship with their parents. Like they try to like drive it for TV. And so they beat her up pretty bad. And she came back and she said, look, I need a sabbatical. Like I'm out. You're CEO, pointed to Ashley, you're president. And then we started to kind of get to work with it, moving manufacturing from Turkey back to China, but putting quality controls in place, getting the pattern patterns that were paper patterns, kind of digitizing that. And then the show aired, even though you didn't get a deal, that's not the end of it. So like people call you up and they say, hey, I'm with such and such investment group in Boston, and we saw you on Shark Tank, are you still looking for money? And at that point I'm CEO, she's, taking a sabbatical, so I'm trying to
So you
figure
can
out.
sell the company, who cares?
Well, you still need a
So
permission.
sabbatical, she won't find out.
But folks are coming in. She's still, accessible. It wasn't like that. But I'm now on the sell side of it. I'm Googling what is due diligence, but they didn't teach you that. And so it comes in. Eventually, we kind of run through the process. Some local investors bought the company, but I got bit by the bug. So I reached out to one of the largest investors in Acadian. It was called Andrew Aarons, and I said, I've heard of his firm. Mr. Aarons, you don't know me. My name's Skip Boudreaux. I want to come work for you. I was like, okay. So I went and met with him that day, and he said, well, if you can pass the test, you got a job, right? Like the securities exams test. Went through past that, and then I'm like, all right, I'm ready to analyze companies and build portfolios and manage money. And he goes, okay, go get money to manage. And I was like, oh, I knew this. He described it to me. I thought it'd be easier, but I'm like 23 at this point. None of my friends or family have a lot of money, and even if they do, it's their parents, and they already have a guy or a gal who handles it. And so that's the most difficult part for me. I just want to sit behind an Excel spreadsheet on the keyboard.
Like we all do.
Yes, but sales is always a part of it. So kind of through that, Andrew invests a lot in startup companies. He has businesses all over, and people constantly come to him and say, hey, will you fund this? And so I was able to kind of sit next to him in those meetings, and he kind of taught me how he evaluates companies, how he looks into what investing. And then eventually, I kind of spun off and was doing that for him. And so now we have bandwidth so he can look at new companies. I said, hey, look, now we just need to open up the faucet because we have this capacity now to fill it with more deals and more opportunities. So that's whenever we found Angel Investing Networks. I lied to you, this is probably the 10-minute version.
That's okay.
We found Angel Investing Networks in New Orleans, and we reached out to Mike Eckert over there, who runs it, and he said, hey, look, if you're interested in it, there's some folks here in Lafayette who are starting up one. It was like Pete Prados, Rick Fontova, Jess Fike, these group of folks. So we reached out to them. The Angels was getting put together, and I came in as Andrew's representative on the Angels. So when deals come in, I kind of look at them, and I come and say, yeah, this one's interesting, and then we'll run it down. Eventually, what ended up happening was I spun off from working under Andrew as an employee. I spun off and started Acadian Capital Research. So Andrew basically, was a client of mine, so I do work for him, but then I can have other clients. So the Acadian Angels became a client. Okay. So we go out, we do the same thing. It's very synergistic. We're looking at the same deals, running the same diligence. So they were a client, and we started getting other high net worth individuals as clients, family foundations as clients, to go through, run the diligence, look for opportunities. They may say, hey, we're looking for a company in the healthcare space, not healthcare, education space that helps underrepresented students, right? And so as we find them, we bring it to them and we say, hey, what do you think about this one? Here it is, here's the pitch, here's kind of why we think, it might make sense on the, on the front side. And then they'd say, okay, yeah, great, run it down. So then we'll run the diligence. And we run the diligence, we kind of figure out what makes the company tick, how the company runs, what are the KPIs, the whole thing. And then we go back to them and say, here's our diligence, here are the risks, right? Here's some mitigants that they put in place. Here's the potential return on it. What do you think? And they'll say, perfect, we'll cut the check. So they cut the check. Then on the back side, from the portfolio update maintenance side, we know what makes the company tick. We know how they operate, so it only makes sense that we're on the back side to get updates from the company and review it, because that way we can say, they're kind of falling off, or they're doing great. These numbers are looking good. So what we learned at that point was man, we do everything a venture capital firm does except write that check.
Yeah.
So instead of the process of going to folks and saying, well, on each opportunity and saying, hey, what do you think of this one? You know, okay, all right, well, let me learn about it, let me read about it. We said, why don't you just give us a pot of money? And then from there, we'll allocate it into these companies for you, which is a fund, right?
Yeah.
And so we raised the first fund here in Acadian, which once again, raising money and sales wasn't the fun part, but you had to learn it. And so we started that in January 2020. And then,
Perfect.
Oh, it's perfect. And then
Perfect.
oil and gas hit like -$40.
Sure.
Remember that? It was a mess. And so we just kind of did a rolling close, did kind of the final official close in May 2021. We're in our third year of deployment. I think we have 16 companies in our portfolio. We're going to try to get to around 20 to 25. And then, yeah, makes money on the venture side. I don't know where I'm at now.
That's great though.
Okay.
So,
there's more sense than
I mean, because so some of this is just like, your journey was always interesting in talking to you, how it was just sort of the next opportunity, and very much was very entrepreneurial from the standpoint of like, well, then this sort of made sense, and so I then dug myself into there, and then, you know, much like an entrepreneur, I studied all I needed to in 3 days so that I could then present myself as an expert on this thing that 4 days ago I'd never heard of, and now I'm gonna, you know. But what I was excited to talk to you about was trying to demystify the idea of investing and going to seek investing. So because we have such an amazing network of entrepreneurs here in Louisiana, and especially in Acadian, and particularly through our programs. But when it comes to funding, it's like, where do I go? How do I get that? And in a general, sometimes a lack of understanding of, if you get funding, you're giving up something. And so what does that mean? And so I don't know where to start, but just as we try to break down seeking investing and make it less hairy.
Yeah.
Like we're both less hairy.
Yeah,
which is
for
nice.
sure.
You know, is there maybe can we start with just when you're looking at a company to think about investing, what are you looking for? Like what are some signs of like, that's a good indicator, that's something that maybe I'm worried about, but like, you know, obviously it can be company specific, but in general, there are some general things that like, that looks good.
Yeah, there's a lot to unpack there, but
Yeah,
that's a good place to start though. So we're different, right? Because we have a bunch of clients so we have a venture fund that we have investment control over, but we also have a bunch of clients who have different risks, different portfolio allocations, different types of companies that they want to get exposure to, right? Different debt structures or funding structures that they want to get exposure to. So for us, it's kind of like we're absorbing it and we're getting a sense kind of on the back of like, who's this good for, right? Like, is this good for the fund? And if it's good for the fund has its investment thesis. Is it good for this client? Is it good for this family office? Is it, you know, like, what does it fit? And generally what we try to do is give a quick no rather than a long drawn out maybe, because we know what it's like to raise money. And so we don't want you to spend your time on us and, you know, keep sending us documents just to send us documents. We generally try to give you a quick no. So, and my other point is like a lot of other investors from I'd say institutional, more professional sense, they generally have some sense of investment thesis, right? And so like, my point was before you even get into like, this is a red flag or this is a risk, it's like, if they only do these types of deals, they only do operating companies that are cash flow, right?
Yeah.
You can have a great opportunity as a startup and they're gonna pass, and it's has nothing to do with your opportunity. It could be just they don't do those deals, or it could also be, hey, look, we're doing all this stuff right now on the other companies, like we don't have time to do it. It's a no strike call business, right? So like you could sit and take pitches all day and not have to invest. And so that's kind of the frustrating part for folks trying to raise money. It's like, oh, why don't they like me? You know, it's a lot of times it may not have anything to do about you. They may not have their funding source tied in, right? Because sometimes, you know, they got to raise money to get money. If it's individuals, they may not, they may be busy, they may be doing other stuff. It's like the big part of it, so it's more
Sure.
matchmaking.
Yeah.
And then once you get kind of to the matchmaking, it likes it, it fits the investment profile, then we kind of run diligence in the sense, and there's so many different things we look at. So we run it from an engineering standpoint. We have a workflow worksheet where it's we evaluate team risk, marketing risk, technical risk, regulatory risk, legislative risk, competitive risk, like all these through, and then in our sheet tells you okay, who are the founders, and then what to do. Okay, get their background, get their bio, run some cursory legal checks on them.
Sure.
Yeah, and then we kind of build that. And then as you go through, we kind of build risks and mitigants.
Okay.
So what's an example? I'm drawing a blank here, but a risk may be like they are pre-product, they haven't sold anything. Mitigants, right? There's a waiting list, and there seems to be some demand here. There are other competitors who are doing something similar, so we might think there's a demand.
Okay.
That's kind of the sense of it. We kind of put that all together, and then we draw up a report, and we give it to our investors, or we put together a memo, and we make a decision at our investment committee meeting for the fund, and we decide, okay, we're going to do it. This is why. We do a pre-mortem. Like, hey, if this fails, it's because they expanded internationally before they were ready, and it took a whole bunch of capital, and they weren't aware of the regulatory risks of that expansion. Sometimes one of the risks is this will work if they don't do anything stupid. Like sometimes we'll write that down. And so the idea too is whenever investment fails, I think I'm on one crazy tangent now, but if investment fails, we'll do a post-mortem too. We'll go pull why we thought we invested in that in the first place, and we'll write what went wrong, and we say, like, is this something we kind of predicted? Is this a risk that we assumed? And if it is, we don't feel bad about it. We just say, okay, we took a chance on it, and that was it. If it's something that's from like left field that took them out, it's, well, why didn't we expect that? Yeah, what did we miss? And then we tie it into our process that we can kind of feed it back in.
Sure, just like an entrepreneur would. Like, they took a risk, failed, learn from it, so we don't hit that same thing.
The problem is the winners is such a large, long lead time in the cycle feedback loop. The losers you get quicker when they go out of business. I had a point, I missed it. It was probably based off your original question.
So another thought. So one thing that I liked in hearing that was that as an entrepreneur, just because someone doesn't want to give you money doesn't mean you have a bad idea. You may just be catching them at the wrong time. Right? And so, in some ways, if you're still making sales, if you're still, we talked about this the other day, like, one of the biggest maybe indicators is, have you made sales? Like, have you sold something? Because that tells me that there is definitely at least someone who wants it, versus I think, and because the feeling is not always, but the feeling is sometimes, if I just had this money, then I could, and sort of our feeling has always been, well, like, money doesn't fix bad ideas. If it's a bad idea, it's a bad idea, and so there's sort of that side of it. The other thing I wanted to ask is just if you could talk a little bit about if you're going to get money, you're going to give up something. So what does that look like, and what are the kinds of things that you may be giving up, quote unquote, whenever you're seeking investment?
You're gonna hate me. Going back to that card that you sent, like we call customers. We call other investors. That's like a big part of what we do. We write them up in memos, and so like that's a lot of it, where we get a lot of the best information. We'll call other investors who might have passed and try to get a sense of time. Sometimes it's it didn't fit our scope, but sometimes it's hey, we found this, but like we call customers, hey, what do you like about it? What do you think would be better? Like that's a big piece of our work. The question that you asked, I forgot because it was on that. Oh, what do you give up? Right?
Yeah, what do you give up? Because and I thought that was interesting whenever we had talked about it was, sometimes but also what you're getting. Sometimes you're getting money, but let's say that your company often goes in and takes in some of the back end stuff, which also allows you as the entrepreneur to do what you love and what you're good at.
Yeah.
You know, and so there are multiple ways for you to get invested in. And so, yeah, but you have to give up something. So
Yes, yes. So, all right, there are different ways to think about it, but I look at it from a sense of you have economics, like dollars, and you have like regulatory and control, right? These are levers you can pull, right? So like back in the day, say back in the day, 4 or 5 years ago, you know, all these companies want to be unicorns. And so to be a unicorn, you have to have a valuation of $1 billion. Where, like, it made no sense for them to be valued at $1 billion, but they wanted it for a status to get on the Forbes 40, whatever. And so what would happen is investors would say, yeah, look, we'll put it at a share price that makes you at $1 billion, but, right, we get this liquidation preference right off the top before anything else. We get these many board seats. We get, you know, some anti-dilution protections that are full ratchet, which are they just bake in all these different things because you're so focused on the share price, right? And so, kind of going back is like what you give up is a piece of your company, control over your company, shares of future profits when you sell or distribute. Like it's not there's an exchange, right? And so it's not free. You know, the investors want some sort of return on their investment, and if they're giving up the idea of a larger economic return, well, then they want a better hold and control so they can watch what's going on from a governance standpoint. I don't know how else to make that, but does that make sense? Like, it's not, you know, it's not a grant, it's not a government program, and even those we were talking,
like
they want you to write a
grants
report.
still want, like, you may get a grant, but grants want you to do this scope of work, and you better report on it, and it better be what you said you were gonna do, otherwise you're never gonna get a grant again, for sure.
Yeah, it's a transaction, you
Yeah.
know, for sure, but I like to break it up into economics and governance and control. And we can play with these all day. You know, if you're stuck on one thing, that's fine, I'll adjust these. If you're stuck on this one, it's fine, I'll adjust these.
Sure. And this is where we sort of got back to, you know, if you're going to an investment firm, you know, sometimes you're giving up control, you could be giving up equity for sure, you know, and so in some instances, at least a bank's just asking for money.
Thanks.
You
Yeah,
know?
if you can get bank funding, get bank funding. The reason why it's a much better alternative is we were kind of discussing this, like when you have like debt versus equity, or maybe debt with some sort of equity kicker, right? Like from the investor lens, if I loan you money and you pay me, you know, a 10% return, right? Or if I give you money and I purchase equity, right, on this hand, right? If everything goes bad, well, we lose all our money and we never get paid our 10%. If everything goes bad, we lose all our money and we never get equity, right? But if you blow it out the water, I get all this upside if I'm equity. But if I lend you money in a debt structure and you blow it out the water, I get 10% for taking this amount of risk, right? And so the banks generally just only want that 10%. For whatever reason. Now, their underwriting is going to be stricter and they're going to have different kind of covenants on it. But that's generally where, like, at least in my eyes, the risk return is asymmetric. It doesn't make sense on the other side. So we'll always want some sort of upside kicker.
Sure. Yeah. But then, so that's sort of on the, hey, maybe the bank that just wants the money, or only wants money. But then the other plus side of, let's say that you find an investor, is that money's not the only thing you're getting. You're also getting you and all of your previous knowledge and all of your, you know, so all of an investment firm's previous dealings. And so, hey, maybe they've seen this before, and this could be a problem that you're gonna run into, because we've had companies like that where obviously a bank's not gonna be able to give you that kind of feedback and guidance.
Yeah.
You know,
It depends. I mean, if you're friendly with the banker and you kind of talk with them, they'll give you what they can see. But I mean, even from our side, right? Like, sometimes we can be helpful, sometimes we can't. We try to make sure that like we know when we're not being helpful. Like there are some companies that we fund where like they're rocking and rolling. You know, we're just giving them money, and Andrew, my mentor, like I said, he has this saying where it's like either right in the front of the carriage, where you're kind of steering the horse, or you just ride in the back. So there are a lot of investments where we just invest, and he's happy. Like other people are pulling it, we ride in the back, and you know, it goes. But there are other ones where you got to come in and do work, and you know, we try to you know, offer connections and advice where we can. And it's also one of those things of what I said. We're building a portfolio of 20 just on the venture side. Mm-hmm. You know, we have another, 20 just scattered through, you know, from our other clients' investments, if not more. Like, you can't go and help everyone.
Sure.
But yeah, we try. You know, sometimes we'll say, hey, this portfolio company could use this technology from this one, and link them up. We've done that several times. Yeah, I don't know where it's getting.
So I want to leave some time for questions. We've got some different entrepreneurs in the audience, and you know, so I'll ask one more question, and then you guys can think about something because I don't want to put you on the spot. So, is there a time where, hey, I'm starting something? When do I go and try to find an investment? Like, the time is going to be different per company, but you know, at what stage do I start to say, hey, listen, now I feel like I've got enough evidence, I've got enough something that I should go after something.
Yeah.
That I should go talk to someone.
That's a good question. So the bar has moved kind of over time, right? So it used to be like right at the beginning when you're trying to start something, you need a whole bunch of money because you have to go, at least in the technology, you have to go buy physical servers, and you have to go buy all this software to start, you have to go buy all this other stuff, right? Like those days are gone. Now you can rent server space on Amazon. You know, most software is software as a service. You could kind of try. The barriers to startup are much smaller on the technology startup side. And so investors have moved a little bit more downstream because of that. And there's more of a flight to safety. So now what most investors are, I say most investors, they're different investors for kind of different stage, but they move more towards product market fit and you know, some success with the product and service. Because it's so much easier to get there for an entrepreneur without a whole bunch of capital. Okay. I'm speaking more in the venture side of it. Sure. Heavy industrial, whatever, you obviously need equipment and stuff like that. It's different. So generally what you want to do is reach as far as milestones as you can to keep your equity, keep your company, and keep your control as you can. And that may be get those sales, get those pre-sales, kind of build a functioning something that's maybe not perfect, but you have money coming in the door, and show that there's product market fit. Once you have product market fit, and you have folks who have a strong desire to use your product or to use your service, like at that point, venture capital is mainly there to scale, right? So if you have, as a founder, like, hey, I can go and sell and sell and sell. Venture capital is there for, okay, well, what if I hire a salesperson? I kind of train him to sell or her to sell, and then I need money to go hire 20 salespeople. Or, hey, I developed this, you know, inbound marketing technique, right? But like, you have an engine. So we'll look at LTV versus CAC, right? So the lifetime value of the product service from that customer. Over how much it costs for you to acquire that customer, right? And so generally, if you have those metrics there and it's positive, like you're gonna find investment, you know, if it's, you know, 4 to 1. For example, I run Facebook ads, I run Google ads, I do outbound calling, I spend $2,000, right? And I get 100 customers. Right? So each customer costs me 20 bucks. But I'm selling them something, you know, at $10 a month, and then the general lifetime, let's just say they churn out after 1 year, right? So it's 120 bucks. Now, there's some different models in there, but basically, so in that scenario, right, the lifetime value is 6 to 1. That's your ratio. And so anything over, 2, 3, 4 shows some sort of product market fit that you can acquire customers, effectively and generate a profit on the back end. But also there are nuances.
Sure. But so it gives you an idea.
Yeah.
I think the product market fit part, I think, is the part that I think
and that's how
it's beneficial for people to take away.
That's a heuristic of product market fit, like to kind of quantify it and just say like, there's something here because these numbers match up, right? Like, there's something profitable here.
And the idea of just taking it and going as far as you can with it before, which is not that different than for so many of our entrepreneurs who it's side hustle, right? Like it's side hustle, and encouraging side hustle as long as humanly possible until it makes sense to kind of let the domino fall. Seeking investment might be the same strategy. And then just like take it as far as you can, because then you own it and it's yours and all those things. And then it's like, okay, now I gotta try. Questions from people who maybe want to know more about this.
I have a question. What does it really mean, like if you have to give away like 15% equity in your company? Like what does that really mean?
Like the mechanisms behind it?
Well, like, is that like just on the profit that the company makes? Is that on the bills that the company has? Is that just on? I never just understood what that really meant.
That's a great question.
Like practical.
Someone says like, I own 15% of your company. What do I own?
You own the units or shares of the company, right? And so whatever profits are distributed, right? It gets distributed according to that. We call that cap table, so your capitalization table. So let's say you have 85 units, other investor has 15. And so if you generate $1,000 worth of profit, right? Those get allocated on your K1s differently. Sometimes C Corp, so it's not a K1, but if it gets distributed, that breaks up how you're distributing profits. And you may say, oh, that sounds great. I'll just pay myself a large salary and then have $0 profit, and then I don't have to split anything. Investors have thought that through. That's where the control piece of it comes in. And so a lot of times you'll come in and you'll say, I'm on another tangent, but basically the way that works is, hey, we have some governance in here. You can't adjust your salary above X dollars without the vote of this investor board member, right? But that's practically how it happens. And then if it sells for $10 million, right? Well, the investor gets 1.5, you get 8.5, assuming there's nuances with liquidity preferences and whatnot. But generally, that's what it means. The company handles all the bills. Company generates all the profit. It's just kind of at the end whenever it comes through.
Okay, it's kind of what I had in my head, but I just didn't really know what it meant.
Now there's some nuances, so it's not like a standard, but generally.
No advice is legally binding.
No,
Let's throw that out there. There is no legally binding advice, and everything that can change tomorrow. Bridget?
I have a question about, do you guys work with the youth? If the youth has, we have a big push for the youth entrepreneurs. So I don't know, where does that fall within your company? Have y'all ever invested in a youth business?
Young businesses, no, we haven't.
Okay.
It's difficult, right? So like on my own personal side, I'm involved with junior achievement. I'm teaching my kids class Friday. I have to go pick up the box, and Miss June's awesome, and Lauren's awesome, and like that whole piece of inspiring you, I love, and try to help as much as I can. From an investment side, it's difficult because our mandate is to generate returns for our investors. Now, if there's some rock star kid who is investment quality worthy, and I can go and defend that to my investors, if they blow up, I can say, look, it blew up, but look at this, you would have made the same bet. Then yes. So it's kind of difficult whenever your mandate is generate returns. Now it doesn't mean that an investor may say, hey, I want to do some impact investing and kind of, invest in youth, but I think that may fall a little bit more on the philanthropy side of it. Hope that was a good answer, non-answer.
Right.
I'd love to. I try to get involved as I can, but from a business standpoint, it's just not practical. Hey,
What's been your greatest failure and how did you learn from it?
oh geez, it's like
Such a solid question.
I know, but
It's a
it's
student.
like I'm
It's
applying for a
It's a
job.
student sitting in front of his teacher, asking him questions, trying to get extra points. That's what it is. Well done, Jackson. Well done.
Greatest failure. I mean, we've had some companies go out of business. We've missed out on some opportunities. I don't know. I don't really think of life that way. You know what I mean? Not like
It's a goldfish mentality.
yeah, like Ted Lasso.
Yeah,
He's a
exactly.
goldfish. But
Being a
like,
goldfish.
I'm not saying like I'm always a winner and I don't make mistakes. I do, but it's just like in the rearview mirror. Hey, our company, we invested in a company that was skincare, kind of like matching, duplicate matching. They're kind of selling to influencers. It went out of business. I thought it was a good opportunity. But like we go back and we post-mortem it and we say, okay, this happened. What did we do wrong? How could we do better? This is an answer, not answer right here. It's very Miss America. But like, I just don't think that way. I'm trying to think of like stupid mistakes, and I'm sure I've made plenty. Man, I don't know, dude. I'm sorry.
That's all right.
What it sounds like is a growth mindset
Yeah.
versus a fixed mindset, right?
Yeah,
Or-
it's not.
I mean, everything was one more reason, one more way to do
It
it.
just
right.
made it go to the
One more
next
thing,
level.
hey, let's pick up on this. Or it was a failure that we anticipated. Like we thought that, hey, like there is a scenario where this isn't gonna go right. And then that scenario happened.
Yeah, and you try new
Yeah,
things.
and like, because all of it is risk mitigation.
Yeah.
I mean, like, at some point you have to jump. At some point you have to leap into the water, you know? The goal is to see the bottom.
That's a good point.
But at some point you jump
Never really had
and you decide, hey, there's a 12% chance that this goes sideways.
Yeah.
But whenever we started looking at it, it was a 50% chance. We have whittled it down to 12%, and now we jump, but knowing that there's still a 12% chance, you know, and that's okay. And I think that's where you realize, or that's where you get to that point of what level of risk am I willing to take.
Yeah, that's a
Yeah,
good point.
and it's different for the investor.
So it's like I've lived my entrepreneurial journey kind of in that risk mitigation mindset, right? So I'll tell my interns when they come work for me, I'll tell my analysts, like, I'll let you drive away the car, I won't let you wreck it, might get some bumps and bruises, but like, you're not in a position where you can ruin us. So like, take risks, do whatever, but like, they're guardrails. That's very like Ray Dalio kind of thinking, and I've kind of lived it through, I just haven't taken many massive, I have taken like one or two massive risks that paid off, but like most of them, let me try this, see if it works. If it works, we'll put some more energy into it. If it doesn't, it's done. Let's try this. If it works, we'll put some more energy. If it's not, and then you just kind of squirrel through.
Yeah. Yes.
Hi. From your perspective, as an investor, obviously, what types of businesses do you generally invest in, and which types do you generally try to stay away from?
Once again, it depends on where that money source is, right? So if it's for my fund and I have a mandate, those are high growth startups that can generate outsized returns, right? If it's on, kind of family office or kind of high net worth, it's really up to the investor who I'm doing the diligence and kind of sourcing for. Generally, right now they're moving towards looking at like operating companies or kind of generational transfer companies, where the operator is kind of moving out, but they don't have anyone to pass pass it on to. Those are pretty interesting right now because they're generating cash flow. They're very easy to model, and you just don't screw anything up. But they're getting priced up a bit. But yeah, and then on the startup side, like I said, it's got to be kind of high growth usually. The way I think about it is probably not the most, the best mindset for like economic development. But the way I say it is like starting a restaurant in Lafayette is probably just as risky as starting a tech startup, right? Like there's so much competition out there. There's so many ways to fail. Lafayette hugs you for 4 months, and then then they decide like Toy Story, like I'm done playing with you, which I hope isn't the case for Parish Biscuit.
Yeah, I was about to say,
You guys should
speaking
go
of
visit.
taking giant risks, let's talk about the
Which you guys should go
investment
visit and
you
get the
made in
Acadia. It's awesome. But my point is, if you do really well and you knock it out of the park on a restaurant, right? Like you might have a business that can generate $2.5 million a year, right? But the same amount of effort and work and sweat and grind goes into a tech company, you could have an outsized return, right? And so there's kind of like this mindset of like, it takes the same amount of energy to run a hair salon or a coffee shop or a restaurant than it does to run anything much bigger. And so the idea is like, if you have the chance to do something bigger and you have the capital access to do it, then might as well do it, because your return's gonna be outsized. And either way, if it doesn't work, you're dead in the water anyway, right? Once again, an answer, not answer, but all kinds of companies, generally not Main Street businesses, just because the return profile isn't there for the investor. With the exception of if an investor wants to do it. Parish Biscuit, Andrew's been wanting to open a restaurant for the longest time, and so he funded it. We're helping get started. The food's delicious. The chef is from Cafe Vermilionville, and I'm turning this into a plug. Parish Biscuit.
I was there on Saturday. I was there twice and I had the Acadian, so I don't miss
But
it.
the information on Parish Biscuit is the only real information you've committed to give. If there was any doubt that, hey, maybe the election season is over, it is not, very clearly, as we do not want to make any definitive statements.
Gift cards are a little soon.
There we go. Any other questions?
Hey,
For a first-time investment company that's looking for a first-time investment, and that needs a lot of guidance, what kind of, relationship would you have with them? Like, what can they expect?
So generally, they come to us and we'll go through, we'll talk with them, we'll get a sense. I usually say my line of like, treat me like a fifth grader who knows nothing about it, and just kind of put me in the ballpark so I can kind of orient. From there, we'll get a sense of like, what are you looking for? What are you looking to do? Whatever. From there, I'm trying to formulate in the back, like, what's the best structure to put it? How much capital do you really need? Would a bank loan be better? Are there some SBA options? I'll try to get a sense of that, assuming they're not coming to me already baked and have other investors and we're just kind of filling out around. I'll try to get a sense and then just kind of talk to them, and if it's something we can help with and do, great. If not, I'm gonna try to point you in the direction of a resource and then kind of send you on your way. But what we'll generally do is we'll tell you if it's interesting, and I'm trying to see if the investors would like it. I'll kind of say, all right, let me run this down a little bit, then I'll let you know. If it's something that fits, I'll generally tell you, this doesn't fit, here's some resources, maybe try these folks, they do this. So yeah, we just gotta consult and talk, and if we can help, great. If not the end of the world. There's some companies that like, to your point, like we didn't fund because it wasn't the right timing, it wasn't the right thing, but like we cheer for them, I share their LinkedIn stuff, I'm happy for them. And it's not like like if they make it, I'm happy for their success. I don't feel like I missed out on anything. It's it's just one of those things. We're happy for folks.
What's the relationship like afterwards? So you make an investment, so kind of to the point of equity. right? So we know kind of on the back end with the disbursements and everything. But what's the relationship like after? So you put the money in, and then what's your role as investor?
Yeah, we say good luck, bye. No, we, so if it's something where we can help and jump in, like we kind of alluded to, we kind of merged with our operations team, we have Acadian Capital Group now. If we have control of the company, then we'll drop in our ops team. Generally, what we're talking about is we don't have control, there's some minority. So what we'll do is we'll reach out for updates, you know, at minimum once a quarter. So we have an update template if you want it, we could send it, and basically this is what's happened this quarter, these are our key metrics, here's some good things that happened, here's some bad things that happened, here's what we need help with, you know, if you guys know anyone. And, you know, we generally kind of expect some level of update. And if we don't get it, we have our software that we build. Basically, every company that we're invested in or our clients invested in go into our software, and then we have a day since last update counter. Yeah. And so if it gets over 90, my interns are calling, I'm calling, Thomas is calling, we're trying to get in front of you, and we're gonna hound you until we get some sort of update. Then we put the update in our system, so that way our investors can get updates on each of their portfolio companies. But generally that's it, update, but you gotta tell us, hey, we're struggling with this, we need help with this, do you know anyone in this? If not, we're just gonna assume, you know, everything's fine, or we'll know, or we're gonna assume everything's not fine. But generally, like, it'll be what it is unless you ask for help or give us some sort of update. But we'll generally ask for the updates or hop on calls and plug them in.
Thank you.
So, I mean, I want to be mindful of some time and sort of wrap things up. Is there any, one other thing I was thinking about is, at some point, the entrepreneur comes into play too. And I think so much whenever, particularly if people see Shark Tank and things like that, there's the idea, but then there's the person attached to the idea. And whenever you guys are either looking for investments or looking for things, at what point does the person come into play? I don't want to lead you in any direction.
Yeah, no, we've done a few of those where it's like, I don't know if this business is the right business or this model, but we'll look at it and we'll say, but like, he'll figure it out. Yeah. You know what I mean? Like, she'll figure it out. Like, we've done some of those where ordinarily probably would have been close, 49-51 the other way. But like, you see the entrepreneur, you just say like, they survived this long, you know, they're you know, go in cockroach mode when they need to, and they'll come out. Like, yes, we've done a few of those. There'll be some where it's like, oh, the business makes sense, but I just don't trust this guy. Yeah. You know, and then we'll just kind of say, we'll pass, we can't get there. And that's usually a function of the openness and communication during the diligence process. Hey, can we get, you know, some financials? Well, you know, hold up, well, let me get them. Then you get them back, and they're not quite what you, you know, to the level that you thought. You kind of get a sense of the level of sophistication. Then you think, okay, is this something that's trainable and teachable? Is this something that they can hire to fix? Like, so that becomes a risk, right? So not really financially sound. Yeah. And then the mitigant is we can hire someone to do it, no big deal, right? But if it's like, they're kind of squirrely and we don't really trust them, there's no real.
Yeah, when it comes to that, yeah, like, I mean, like, we can work around you maybe not having your financials in the exact order that I want it in, or do whatever. But if I have to ask you 6 times to get some information, and you send me like some like partially done, like that's
written on piece of paper,
like I can't fix shady. Yeah, like I mean that's sort of.
But yeah, and generally that's like that's less common.
Sure. Yeah, I mean, I think that point. But I love, I mean, it's, particularly because we think about the entrepreneurs that we have in Acadian.
I'll give you an example of that.
Yeah.
All right, so one time there was one, I don't remember the exact numbers, but let's say they said, oh, look, we're doing $2 million in revenue, right? We have this product and they pitch us this whole product and it's $2 million in revenue, right? Yeah. Whenever we look, 1.7 million of the revenue, making up these numbers, is of a completely different business that's not really innovative. It's just like a blocking and tackling business that they don't mention at all on the deck. But they're trying to pitch, you know, hey, this is a business. It already has success. It does 2 million in revenue. And when we look at it, it's different segments.
Yeah.
And that was one where like, it just didn't feel right.
Yeah.
They knew what they were doing.
Yeah.
You know?
Yeah, that's someone who is intentionally sort of saying, just trust that there's money.
Right.
Don't look at where it's going. Just it's over there.
Yeah, I don't know, and I don't put on a scale of like how
Sure.
deceptive, you know, it was. It could be maybe that's how they think about the business,
Yeah.
and that's their lens. But to us, it was just very like, it's not being represented the same. Once you dig in.
But it makes me think about, again, the entrepreneurs in Acadiana. Listen, there's a fight level that's just, that's
Yeah.
pretty unique.
Yeah.
You know, as far as you talk about the willingness to continue to work and strive, and I'm gonna keep grinding this thing, and I'm gonna work 4 other jobs, and I'm gonna do this other thing, but I'm still attached to this thing that I love, or this thing that you know, the people baking at home, the people who are, you know, trying to put together consulting things all over the place, or they're traveling with their chiropractor table because, hey, you never know, there's a possibility. Like those, you know, that mentality is the thing that, one, it's the thing that makes the community so good, but it's also the thing you can't teach. Like I can't teach that part of
It's
it.
that
you know?
wildcatter mentality.
Yeah.
Like we're just gonna go for it.
Yeah, absolutely.
That's cool.
Skip, thank you for being here.
Yeah.
Thank you for mostly answering people's questions
Sometimes
and
not.
plugging Parish Biscuit. So other than that, so thank you all for being here. Next week, we're going to talk to Chef Sky, who is actually one of our grad assistants. And so for the past 2 years, I think, maybe almost 3 years, he and his wife have been popping up at the farmer's market and Mediterranean desserts, and maybe we'll get some samples. So if you're here next Tuesday, that's what you have to look forward to. If you are virtual, then I encourage you to make your own baklava, and you can join us from home. But
Which is not easy.
which is not easy. All right, thank you everyone for being here, and yeah, perfect.
I thought football was awesome. What was it, Accelerate?
Oh yeah, the pitch.